Hello, everyone. My name is Michael Lamott. I am the founder of ChartYourTrade.com, and I wanted to talk to you today about the markets. They are beginning to be a little bit choppy. We've seen some chop and slop over the past week and a half, and I thought it would be a good idea to do a video, try to work some of this out with you, and hopefully put some concerns to rest. So, what we're looking at right now is a chart of the S&P 500, a daily chart of the S&P 500, and the charting service that we're using is a charting service called TradingView. I like TradingView quite a bit. One of the reasons why I like them so much is because they allow you to do a lot of customized work. So if you see all these little flags on the chart, what these flags are pointing to are distribution days. Now, a distribution day is a down day of 0.2% or more on heavier volume than the prior day. So you might be asking yourself, well, why do we care about that? The reason why we care about distribution days is because they point towards institutional selling in the market. So if the big boys are beginning to sell, then it's something that we want to be aware of, and we might want to start pulling back as well. Now, distribution days really only begin to become significant when we see them pile up in a large quantity, when we have 7 or 8 or more than that, and when they begin to come in clusters like they were back here. It often leads to a more significant pullback in an index. So right now, when we look at the S&P 500, we only have 3 distribution days. That's not a lot, and as we're pulling back into this red line here, which is the 50-day moving average, it's a logical place where we see indexes and stocks and really anything that trades. It's a moving average that gets tested often and will be one of the major lines in the sand that we need to watch. So really, since the election, we've rallied hard, and we haven't even touched this red line. And only now, after 4 months, are we even getting close to really testing it. So we only have 3 distribution days. We are just now testing the 50-day moving average. Not a whole lot to worry about just yet. We have rallied for about 15%, and so far this consolidation that we're seeing is really only about 3% deep so far. So again, not that much to worry about. Another indicator that I love to look at, especially on a chart like this, is the number of new highs versus new lows being made. Now, this new high versus new low indicator is of the NYSE. And the reason why I like to look at the NYSE most of all is because it has most of the stocks that I'm looking at. I also look at the NASDAQ. I haven't figured out a way to put it into TradingView yet, but I have another solution to that, which I'll share with you in a minute. But when the reason why I like to look at the number of new highs versus new lows being made is because it really serves as a leading indicator to what's going to happen with price. So back here, we saw the number of new highs begin to dry up in a hurry, and we saw the number of new lows begin to expand. And if you look at it in conjunction with price, we see that pullback happen just as we get this rapid dry up and expansion. Now, what's really interesting is right ahead of this rally, look at this dry up in the number of new lows, and look at how fast the number of new highs started to be made. This is before the election, and then sure enough, bam, we rally, and we've been rallying hard ever since. Now, we have seen a dry up in the number of new highs being made, and we have seen a little bit of an expansion in the number of new lows being made, but it doesn't compare to what we've been seeing back here and we don't have the number of distribution days piling up as we did back here. Back there, we had 12, 13 distribution days, very, very heavy, but right now, distribution days are a non-issue, so that's one thing to be mindful of, and not to get too scared of what we're seeing just yet. Or at least I'm not getting very scared by what we're seeing just yet. So here's the tool that I told you about earlier that will also help us gauge the overall health of the market. It's a scanner that we developed about 2 years ago called Chart Your Trade Market Research Intelligence, or simply Chart Your Trade MRI. And what Chart Your Trade MRI does is it scans for the best of the best growth stocks in the market. It runs 8 different scans over 65 different criteria, and it does it all at a single push of a button. And this week, the scanner returned 62 names. Now, aside from just providing the best growth stocks in the market, which is very significant by itself, it also gives us several important gauges of market health, which we'll take a look at. So the first thing that I want to do is export this, and we could export it to CSV, open it up in Excel. It's very handy. But before we do that, I want to click on this reports tab right here, and what we can do is compare this week's report to last week's, and we can easily see what kind of stocks are coming onto the list, what's falling off, and where the bulk of our scanning results are coming from. So right now, what we're seeing is that most of the stocks that are passing the scanner are coming from semiconductors and regional banks, and we're beginning to see a little bit of growth in consumer financial services and construction supplies and fixtures. So we want to keep that in mind when we go through our list. So let me open up the results that we exported and center it over here for us. And okay, so these are the stocks that passed the scans for this week. One of the things that I like to do to help us analyze is to highlight all of the month-to-date returns for each of these stocks, and just add a little bit of conditional formatting using the color scale here, and do the same thing for the year percentage return. And what this is going to help us do, it's going to help us do a number of things. The first thing that it's going to help us do is obviously see what our strongest stocks are, what our strongest industry groups are. So I just clicked the little filter button up here so that way we could sort the columns a lot easier. So I like to sort it a number of different ways. The first way that I like to sort it, I'll go to the month and see what the strongest stocks are for the month and see if anything pops out at me. And also, while I'm doing that, I'm scanning column C over here to see if there's any industry groups that look like they're rising to the top. And so what we're seeing here is a lot of technology kind of sitting right around here at the top. And when we look at the year-to-date or the year percentage gains, we're seeing it again. We're seeing a lot of technology. We're seeing some of the bank stocks float to the top, and when we sort by industry group, this really helps point out what some of the strongest industry groups are per what's passing our scans. We're not interested in every single stock that's out there. We're just interested in the stocks that meet our high growth criteria. And so we're filtering down multiple levels here. So first we're filtering down on just the stocks that are have high growth presently. And then we're taking a deeper dive into the industry groups, and we want to see which stocks in which industry groups are performing the best, and we want to focus on those here. So when we do our conditional formatting, well, we could really start to see things pop out. Over the past month, we're seeing some growth right over here in the broadcast and the casinos. We're seeing some movement in the construction services, supplies and fixtures. Let's see, what else? What else? Down here, semiconductors were cooling off this month, but if we look at it on the annual, they've been ripping for quite a long time. So, as we saw some stocks begin to show some weakness over the past couple of weeks, it's not surprising then that the semiconductors, which were leading the way, were the ones that are pulling back now. So later on, when we go and take a look at which stocks are we going to try to put on our ready list and play next, we might look at some of these semiconductors to see what's pulling back, and is it finding support at a particular level that we might want to add a little bit, and for a potential low risk, high reward kind of a move. So one stock that's been on our radar for a very long time, since really the beginning of November, and a stock that's been very good to us for a triple-digit winner, has been this one right up here at the top. Ticker symbol AAOI. The company is Applied Optoelectronics. And so in the recent pullback, and anytime we get a nice pullback like we're starting to see in the indexes, I always like to go and see what stocks have been the leading stocks, and how are they behaving? Are they still holding up? Are they offering potential opportunities to get into or add to an existing position? So over here we have a chart of AAOI, and so it came on the radar over here, and the first time that I personally started trading it was right over here. After it had that massive gap up, I entered soon after it made a new high above that gap, with the understanding that if it retraced back below this point over here, that would be my stop, and I would be out. So we've been riding this stock for quite a while, and it's made, from this point here, it's made a move of about 80%. And so in the most recent pullback, and some people like to hold a stock forever for the duration of the move. Me personally, I like to take off bits and pieces along the way. So by the time it got up here, I was only holding about half my position, maybe a little bit less. And so after such a strong move, I knew that it would pull back and that it would test some kind of a moving average. It started to test the 10-day moving average. That didn't hold up. And then it began to hold the 21-day exponential moving average, this purple line here. And so I thought that, okay, it held the 21-day moving average here and back here. Let's see if that becomes or remains an important support level. So as it rallied on this day over here and it started to make a move, I believe I got in right around 48.50 and added to my position there. And at that point, I moved my stop loss, the point that I would get out if the stock moved against me, to just below this low over here. So I had my stop at around 46.50. Maybe around 46.25. just to give me that little bit more of leeway in case it undercut that low. So, stop placement and recognizing how a stock is behaving is super important. What kinds of levels it's respecting or not respecting, because it'll make the difference between whether or not we are going to stay in a trade or get shaken out of a trade. Thankfully, I did not get shaken out of this. So with the stop at around 46.50, and on this day here, it came about 50, 60 cents to my stop loss in the morning, and then rallied for about, let's see, how much was this? I think it was about 9% from the bottom to the top. More than that, 9% versus the close from the prior day, but on the day it rallied about 13% from the low to the high of the day, which is incredible. So stop placement, again, something that's very important, and we can see now that the line in the sand, at least at the present time, is that 21-day exponential moving average for AAOI. Something that I haven't mentioned yet on this chart, and I like to, well, when I'm looking at stocks, I'll take these indicators off. So I'll take off the distribution days, and I'll take off the distribution day count, don't need that, and the new highs, I don't need that. What I do like to look at on these charts, and let me adjust this a little bit, is to look at the relative strength versus the S&P 500. So there's the relative strength for that, and we'll put it on the weekly chart as well. And it just shows you how strong versus the major indexes it has been. And even on the pullback, the relative strength barely pulled back at all, and we're still right near the highs for the relative strength. And so it's telling us that this stock might not be done just yet, and it's still outperforming the indexes by a mile. So that's one of the reasons why I love to look at relative strength as an indicator. The last thing I want to tell you about before I go is this right here. So let's make that a little bit bigger. So this right here are my targets, and the way that I arrive at my targets is by looking at what my initial risk is versus where it could possibly go. So when I make a multiple of my risk, I generally like to begin taking bits and pieces off of my trade. So in this particular example, when AAOI made moved to 51.17, that was making 1 times my multiple from that add-on entry there. When it hasn't hit this yet, 53.45, but when it does, that'll be 2 times my multiple, and so on and so forth. So I find it important to be able to take something off as you begin to make a multiple of what you've risked. Typically, I'll take something off at around 2R, between 2R and 3R, depending on how the stock is behaving, but definitely by 3R, if I haven't taken anything off, I'll start to take something off. Generally, anywhere between 25 to 50%, depending on how the stock and how the market is behaving. And the reason why I like to do that is because I've just seen so many times stocks come back in and wipe out my gains, and so I want to be sure to at least lock in something along the way, and then if the stock comes in, my thought is, well, thank God I sold something. And if it continues to run, and then, well, thank God I didn't cash it all in. So either way, you turn out to be a winner that way. And once I do lock something in, I'm moving my stop up, and typically I'm moving my stop up to the break-even level, which for me at this time would be right around here at 48 and change. Okay, so that's it. That's all that I have for you today. Thank you so much for watching. I really appreciate you tuning in. I hope that you got a lot out of this analysis. Before I let you go, I just want to share with you one more thing. Our tool here, the Chart Your Trade Market Research Intelligence and Analysis app, it's up for an award. We're competing in the Benzinga Global FinTech Awards, and right now we have 430 votes. We need as many votes as possible to make it into the next round and hopefully win. So please take a moment. Go to BenzingaFinTechAwards.com. I've included a link at the bottom of this video. Go there, vote for us. You can vote for us on Facebook, Twitter, or LinkedIn. You could vote on all three platforms if you'd like. And I would really, really appreciate it. The awards are, the competition's heating up, and we could really use every vote, and every vote counts. So if you like this and you like this video, please do us a favor. Go to Benzinga FinTech Awards, help us out, and help rock the vote. Thank you so much, and we'll talk to you soon.